What's up everybody, Genix Dividend Investor here. In this video I'll show you 10 dividend stocks with huge growth potential spread across multiple sectors and industries, including a dividend aristocrat and even a dividend king. I'll also respond to a nasty comment I just got, and I'll tell you about something I did this week that really worried my wife. So let's get into it. I'll share the tickers in this video sorted by forecasted earnings growth, starting from smallest and going to largest. But don't think of smallest as small, because I picked large cap stocks in the SP 500 with at least a 14% forecasted earnings growth and at least a 13% forecasted stock growth 1 year out, along with a historical EPS growth of at least 11% annualized on average over the long run. Okay, so the first company is West Pharmaceutical Services, which makes packaging and delivery systems for injectable drugs, including stoppers, syringes, and auto-injectors, serving the pharma and biotech industries. FastGraphs has its historical earnings growth rate at 12% annualized, and it forecasts a 14.6% EPS growth when looking forward over the next 2 to 3 years. However, it is quite overpriced in this FastGraphs view of the data, where the black stock price line is far above its blue line, which is its PE multiple at which the market has tended to value the company over time. It's also priced far above its orange line, which is an estimate of its fair value. So in summary, its earnings are expected to grow materially, but it's currently overpriced. I'd personally prefer to wait to buy until it's under its blue line, but that's just me. Stocks can remain overpriced or underpriced for a long time, but eventually will trend toward its earnings. That being said, analysts, on average, are very bullish with West Pharmaceutical Services with a 25% upside estimate for it 12 months out. West has a super low 0.2% dividend yield along with an okay 5.8% dividend CAGR, and it has an awesome 12% payout ratio. It also is a dividend aristocrat with 31 consecutive years of dividend increases. Nice. Leave me a comment telling me if you have or haven't heard of this dividend aristocrat before, because I'd guess many folks haven't. I don't think I've seen anyone on YouTube talking about it, though to be fair, I've stopped watching almost all dividend content once I started my channel. Moving on, next up is Microsoft, a company I'm long in, and its historical earnings growth rate is at 13.3% annualized, and it forecasts a forward 15.7% EPS growth rate. However, it also looks overpriced, as most stocks are these days, so while it estimates that earnings should grow materially, the stock itself could still correct. Analysts are bullish on Microsoft and estimate 17% upside from here a year out. Microsoft has a very low 0.8% dividend yield, but has a nice 10.3% dividend CAGR, and it has an excellent 25% payout ratio. It also has a nice 20 consecutive years of dividend increases, so well on the way to becoming an aristocrat. Next up, we have a company that many haven't heard of, which is LyondellBasell Industries, a global chemical company that manufactures plastics, chemicals, and refining products used in packaging, construction, automotive, and other industries. Its historical earnings growth rate is at an astounding 23.2% annualized, and it forecasts a monstrous 17% EPS growth rate. But here you can see that it's about in line with how the market has historically valued the stock, which makes it kind of interesting in this market, so it might be worth digging deeper into the business, its risks, its financial trends, competitors, etc. to see what you think. Analysts' 1-year stock price estimate is 13% up from here. Lyondell has a high 6.8% dividend yield and an okay 4.9% dividend CAGR, but only 11 consecutive years of dividend increases, and its payout ratio is getting up there at 75%. I had to look up what the NV stood for in LyondellBasell Industries, and it stands for Namlosvennootschap, which is a Dutch term meaning public limited company, kind of like a corporation in the US. So a logical question I had is, do investors who buy it have to deal with foreign dividend withholdings on its dividends? Well, I'm not a tax guy and I might be wrong, but I don't believe US investors would face foreign dividend withholding taxes on its dividends. That's because even though they're incorporated in the Netherlands, the company is a tax resident in the United Kingdom, and the UK does not impose withholding taxes on dividends paid to foreign investors, including those in the US. That can make LYB's dividends more tax efficient for US investors compared to other foreign stocks that may have withholding taxes, even though you can claw those back at tax time. Of course, your individual tax situation, like if you're holding in a tax pool versus tax advantage or whatever, might still impact how the dividends are taxed at your end. Given its high yield, I'd want to dive into understanding why the market has driven its price down so much. I'd also try to gauge if its dividend was sustainable relative to its cash flow and debt and such, because big percentages like that give me pause. Okay, let's continue. The fourth of 10 stocks is Nucor Corporation, a US-based steel manufacturer. My main concern with Nucor is that the markets are kind of jittery right now. Things like tariff wars might not be favorable for a company like this. Plus, it probably would do better if rates went down and construction went up. Its historical earnings growth rate is at 19.2% annualized, and it forecasts a 17.3% EPS growth rate. Analysts are quite bullish with 34% upside from here. I'd be interested in digging into what went on with this stock since the pandemic hit. It's got a low 1.8% dividend yield, a 6.3% dividend CAGR, and I generally want to see a higher dividend CAGR when the starting yield is that low, but it is a dividend king with an extraordinary 51 consecutive years of dividend increases, along with an excellent 20% payout ratio. Next up at the halfway mark is a name you'd recognize in Dell. Its historical earnings growth rate is 24.3% annualized, and it forecasts a 17.7% EPS growth rate. Analysts are very bullish with 43% stock upside from here. It's got a low 1.7% dividend yield and doesn't have a 5-year dividend CAGR yet, as it's only paid dividends for 2.5 years, but it is at 2 consecutive years of dividend increases, along with a nice low 23% payout ratio. After Dell, we have Eastman Chemical, a global specialty materials company that produces a broad range of chemicals, additives, and advanced materials used in industries like automotive, packaging, and consumer goods. Its historical earnings growth rate is at 14% annualized, and it forecasts an 18% EPS growth rate. Analysts are also keen on the stock with a 21% upside estimate 12 months out. Given its potential EPS growth combined with its current pricing, I'd say this company merits more rigorous analysis as something that might be intriguing to get into. And again, I'm just touching the surface on a few quick metrics, but I'd dig a lot deeper before I'd actually press the buy button. Like I'd look at financial trends, the market, competition, etc. It's got a 3.6% dividend yield, an okay 5.3% dividend CAGR, a decent 15 consecutive years of dividend increases, and a nice 44% payout ratio. Next up is a well-known stock in Broadcom. Its historical earnings growth rate has been incredible at 31% annualized, and it's forecasted to grow at an eye-popping 21%. Analysts have it at 17% up for their 1-year estimate. But what would give me pause is its valuation right here, where it looks much too frothy for me. Now that doesn't mean it can't keep going up at these inflated levels, but I'm too conservative to jump in at these prices, even with all the good growth potential. It's got a low 1.2% dividend yield, a great 14.1% dividend CAGR, and has 14 consecutive years of dividend increases, along with its nice 45% payout ratio. Following that semiconductor company is an even more famous one these days in NVIDIA. Its historic earnings growth rate is a mouth-watering 37% annualized, and it's forecasted to grow at 35% for the next 2 or 3 years. Analysts are very bullish given all the AI craze, and have its price going up an eye-popping 49% from here. But to me it looks pretty expensive, but man, look at that earnings line. Of course, nothing is a sure thing. Like most of you probably are aware of how this week a Chinese AI startup called DeepSeek announced the release of an AI model which looked a lot cheaper than US AI models. This development raised concerns about the future of American AI dominance, leading to a significant sell-off of US tech stocks. NVIDIA actually dropped over 8%, erasing almost $600 billion from its market cap. However, experts suggest that the intense competition may lead to cost reductions and broader AI adoption, potentially benefiting American companies. Plus, the costs that were shared from DeepSeek weren't an apples-to-apples comparison to companies like OpenAI. And really what's happening is that in times like this, a bit of good news or bad news drives a lot of people to overreact in the market, thus the swings we saw. And sure enough, we had a quick market rebound that indicates that the initial panic may have been overdone as investors reassessed the implications of DeepSeek's emergence. NVIDIA's yield wins the lowest yield of the year at 0.034% because its stock mooned like crazy with all the generative AI stuff. It's got a 5-year dividend CAGR of 16% and only has 1 consecutive years of dividend increases with a redonkulous 1% payout ratio. Basically, it's an extreme case for a growth stock, but it officially pays a dividend, albeit a tiny one. But hey, sometimes good things come in small packages. At least that's what I tell my wife. Moving on, and second to last, is Eli Lilly, a well-known healthcare company. Its historical earnings growth rate has been a nice 11% annualized, and it's forecasted to grow earnings at an insane 36%, with hefty contributions coming from their GLP-1 diabetes and weight management drugs. Analysts have their stock going up 26% in the next 12 months, which is pretty crazy given where it's already at. But as this fast graph shows, it is quite spendy, and would need years of solid earnings just to get to where it is right now, so I personally wouldn't feel comfy investing. And finally, 10th in the list is Micron Technology, a semiconductor company that designs, manufactures, and sells memory and storage solutions. Its historical earnings growth rate has been an awesome 18.8% annualized, and it's forecasted to grow earnings at an unbelievable 54%. But those estimates could be shot if computing memory computer demand slows down, and or if their competition heats up. But analysts are super bullish, thinking that their stock will go up 48% in the next 12 months, which is insane. Its fast graphs looks pretty interesting, and take a look at this earnings drop-off in 2023. Apparently they had a big decline due to weak demand for their memory chips, primarily caused by an inventory glut, declining PC and smartphone sales, and slower data center spending. They reported negative earnings, marking a major shift from its strong profitability in previous years. And to navigate that downturn, Micron implemented cost reductions, including layoffs and capex cuts to manage inventory levels and improve future profitability. So by the end of 2023, Micron saw some signs of recovery, aided by the improving AI-driven demand for high-performance memory chips, but profitability remained under pressure. It's got a super low 0.5% dividend yield, and they've not increased their dividend since 2022. Still pretty amazing. Okay, now I'll show you a few companies that didn't quite make the list. So we have Intuit, Google, Sherwin-Williams, a dividend aristocrat who's almost a king, and AbbVie, who's a king. Feel free to take a snapshot if you'd like to dive into the details. So overall, I shared 2 healthcare stocks, 3 material stocks, and 5 tech stocks in the list. Okay, now I want to switch gears and finish things off and tell you about a nasty comment I just got and tell you about something I did this week that really worried my wife. So I was recently talking to someone on my Discord who was surprised that I sometimes get nasty social media comments on my videos because my content seems positive and inspirational and such. But here's one I got in the last couple of weeks to give you a flavor of what I sometimes see. And side note, I didn't actually originally even see this comment because YouTube automatically hid it in a special spam folder, which I know about but don't often check. And the new thing I learned was that the spam folder itself has another spam folder hidden within it for even more offensive comments, which is where I found this one. That's kind of crazy that I just found out about it because I've been on YouTube for 5 years. Both spam folders get auto-deleted every so often by YouTube, so I'm sure there are a bunch of other mean comments I've missed over the years. Anyway, this guy said, "Amazing douche face thumbnail. Yet another clueless lemming douche tuber looking ridiculous because they think making a stupid, unnecessary, out of context and unprofessional faces will get people to click," end quote. So first I'll say bravo, as douche tuber is a pretty good pejorative. He was talking about a video I recently did called New Info, Dividends Actually Are Free Money, where I used a lady with a surprised look on her face. Now every thumbnail I put out is ultimately my decision, but I do create a bunch of potential thumbnails for each video, and then my Patreon aristocrats and kings and my channel members will vote for which one I should use. For example, here are the 5 thumbnails I created for that particular video he complained about. This first option was a lady sitting in a chair with money falling all around her, which I felt was appropriate for the concept I was pitching about divvies being somewhat free money. The next thumbnail I could have used was someone holding cash, aka divvies. The third one was a picture of a guy being surprised, and I felt a surprising expression was contextually appropriate because I myself was totally surprised with the information I found and shared in that video. The fourth one got the most votes, and so was the one I used, which was of the girl being surprised. And the last one was this monkey looking kind of surprised, which I also felt was relevant because I had previously made a video saying that dividends aren't free money, so using a monkey was my way of saying that I had made a monkey's blunder. So TLDR, while I could choose to override what my Patreons and channel members vote for, I've historically always gone with what the majority wants, and I try for all of my thumbnails to be in context, though it wouldn't surprise me if some people can't always understand why certain thumbnails pictures are used. Now, the troll is correct in assuming that I want to get clicks, as my goal for my channel is to encourage as many people as I can to invest. Anyway, my suggestion for my troll is to calm down a bit and not get so angered by something so trivial. Nasty comments won't be seen by me most of the time, and you can get shadow banned for what you say. And bottom line, I doubt it's good for your psyche to get so worked up over things. And that reminds me to never argue with a stupid person, as they'll drag you down to their level and beat you with experience. And while the troll might not have been the sharpest tool in the shed, Lynch had it right when he said, "Everyone has the brainpower to make money in stocks. Not everyone has the stomach." If you are susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds altogether. And I'll come back to that in a moment as I finish this off, telling you about the thing which I did which really freaked out my wife. So my son loves sloppy joes, and I made a batch for him, but they were kind of greasy, and what I didn't realize was that my ring that had never accidentally fallen off my finger in over 25 years ended up slipping off my finger somewhere in the house. I realized it was missing when I was typing on my keyboard and didn't see it, and that kicked off a frantic search where everyone in my family went looking for it. My wife ended up looking through the garbage can outside the house because I had emptied all the bins earlier in the day since the garbage guys were coming in the morning for their weekly pickup. And that's where she found my ring sitting in a pile of kitty litter. The whole ordeal made me think about investing mistakes. I mean, too often people panic and dump investments at the first sign of trouble, assuming all is lost, just like I almost did with my ring. But smart investors, like my wife in that moment, stay calm, sift through the mess, and find hidden value. They don't rush to sell a stock just because it's underperforming or let fear cloud their judgment. So whether it's a lost ring or a beaten down stock, the lesson is the same. Don't make rash decisions and have a process. Sometimes what seems like garbage at first glance is just a little buried treasure waiting to be found. And with that, I'll close things off and suggest that if you enjoyed this video, then please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Consider using my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off the first payment, even if they sign up for a full year. Plus, don't forget to join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.